Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
Hello and welcome to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and today we're going to be doing an episode with VSM. So welcome to the show, and I think you're going to enjoy this. VSM actually interviews me on this episode. They are a young, energetic, and very promising company in the Twin Cities. They are a full-service real estate company. So they're realtors, they're doing property management, they are representing a lot of investors, and they are investors themselves. So Daniel and Ryan and Goran are on the show with me, interviewing me in their office, and I think you're going to enjoy it. Hope you learned something.
Hello, everyone, and welcome to another VSM Real Estate Podcast. I'm your host, Daniel Krakowski, joined by Goran Vazovic.
How's it going, everybody?
We have Ryan Schroeder.
What's up, Daniel?
And today we have another special guest. We have Todd Dexheimer from S&D Real Estate.
Yes, sir. Thank you for having me.
Welcome aboard.
Yeah, thanks for having me, guys.
We're excited to have you. Can you give us a little insight context of what S&D does, what your focus is in the real estate world?
Yeah, absolutely. I think it's important to start from kind of where I came from. So I started in 2008 investing in real estate, mainly buying single-family houses right when the market crashed. I was buying single families and keeping them as rentals. And then I started buying single families and doing a lot of fix and flips. So from 2008 to essentially today, I stopped doing flips a little while ago. And I shouldn't say stop, but have backed off on them. I've done, I don't know, about 150-ish. And then I've bought a bunch of rentals, so just to try to increase that rental portfolio. Now my business has kind of just changed over to mainly multifamily, and I'm purchasing mostly out-of-state properties because of where we're seeing our cap rates here in the Twin Cities. And I still will invest in the Twin Cities. It just depends on the deal. So my main niche has always been buying distressed, fixing them up, and leasing them out. And we just don't have a lot of distressed properties here, which is a good thing.
Right.
But a bad thing for my business.
Right.
So I've been buying out of state in areas that have opportunities to purchase distressed properties, distressed apartment buildings, and then fix them and hold them.
Do you have any specific areas that you target? Is that proprietary to?
Yeah, no.
Okay.
I can definitely share that. What I target is emerging markets. So I took about a year and a half to research before I went out and bought, and just researched the entire U.S. And what I was looking for was several things, but I'm looking for areas that have good opportunity as far as lucrative capitalization rates, and so basically your return on your investment on the property. And when I'm looking, I'm going, can I get a 10 capitalization rate? And for people that don't know, it's just basically your return on your purchase of the real estate.
Yes.
And so I found some areas that said, okay, I can do that. But then the next step is, well, is that city worth anything, or is that city going down the tubes. Is it
Right.
Is it Detroit from whenever up until just recently? Now Detroit's seen a renaissance, but if you bought
Right.
in Detroit in 1990, you
been
probably
punished,
did.
yeah.
Right. So that's the next step was then, okay, what's the affordability in the market? Is there opportunity for rent growth? And then also, what kind of jobs are being driven into the market, or are there jobs being driven in the market? What's the unemployment rate, and what is the population growth looking like? So I came up with several markets and flew out to a bunch of them, and one of the main markets that I've stuck to right now is Cincinnati, Ohio.
Yeah, I've heard that.
Yeah, it's a great market. Now, the competition there, quite frankly, is really becoming pretty fierce. When I first got into the market, the very first time I took a trip down there, there was a lot of opportunity. Now things are going really quickly.
Who's your competition out there? Is it institutions or just guys like yourself? Or
Yeah, mainly people like me. There is some out-of-state investors coming into the area. Not a lot of institutions yet in Cincinnati. They're starting to view that market as a good market. Institutions like the big markets, the Dallases, the Houstons, the New Yorks. So they look at Cincinnati after they can't find any value in those big markets.
Right.
But a lot of local people are starting to see there's value, and a lot of out-of-state people. I just went to a real estate seminar the last time, mastermind, the last time I was there in Cincinnati, and there was 2 other out-of-state people that were interesting enough at that mastermind group.
That's pretty good.
Which is pretty good.
Yeah, you like to hear that.
And it was a group of 25 people that showed up, and it's good and it's bad because it brings in the competition. But that just shows you that it's a healthy market.
Yeah.
Becoming healthy.
What metrics did you look at to make that determination of Cincinnati over, I've always been very interested in Jacksonville, Florida.
Yeah, Jacksonville's a great market. Actually, Jacksonville, I've got about 15 markets on my list that fit my bill, and Jacksonville is one of them. Milwaukee is another decent city. The only problem with Milwaukee is that you're not going to find a lot of opportunity in the $1 to $5 million property range. You're going to see a lot of opportunity in the duplex, single-family duplex up to fourplex range.
Right.
So if you're looking for the smaller stuff, Milwaukee's a great market. Good cash flow, and decent fundamentals going on right now. But yeah, the metrics we're looking at, like I said, the job growth, what's going on there? Are we seeing improvement? Also, what kind of opportunity is there? Are there distressed multifamily? The Twin Cities is a unique city. It's a pain in the butt if you're a property owner or a property manager, because you have to manage your building. You can't just leave things that need to be fixed. You can't just leave them alone.
Right.
But other cities, you can. And so Milwaukee, for instance, they look at the exterior, but they don't have interior inspections.
Interesting.
Wow.
So the inside of the buildings are unreal. I mean, they're so bad. And I walked into some buildings where people are living in them, and you just can't believe how can people actually physically live in it. That you can't get by with that.
I think that here sometimes.
I think that here as well. I agree. Yeah, but we in the Twin Cities regulate it. Minneapolis now has the tiered program, and if you're a bad problem property, you're going to be inspected every single year.
Right.
And Cincinnati, Milwaukee, a lot of other cities, most other cities don't have that. So our housing stocks is really solid. As big of a pain it is for a property owner, it's a good thing.
How do you grapple with the ethical component of that, knowing that you can get away with leaving your properties in disrepair? Obviously, we know, being rental owners ourselves, that if you want to attract the top quality tenants, you have to offer the top quality product. But where do you make those distinctions in a market like Cincinnati, where the rents are maybe half or less what they are here?
Yeah. Well, you guys are property managers, and you know that when you don't manage the property properly and don't fix things, your cash flow might look great for a short period of time.
Right.
but it doesn't take long for that cash flow to really start to suffer. And so really for me, beyond the ethical standpoint, I mean, the ethical is pretty obvious. You need to give your tenants a good place to live, right? And they're paying you money. You provide them with a good house. But beyond that, it's monetary. I mean, if you don't take care of your property, if you have to have the city telling you what needs to be done, you're already doing something wrong.
Yeah.
And so beyond the ethical, I would just say it's the monetary. You keep it clean, you keep it rented.
Yeah, it's just good business sense.
Yeah,
and
absolutely.
It makes sense why the city does it. I think the reason that a lot of times people are frustrated with it is either A, they're in our position where they already see the value in doing it that way, and they don't feel that they need that nanny coming in, checking on them, making sure that they're doing what they already know. And then the other side is people are also frustrated because they're slumlords and someone's telling them they can't be. So,
exactly.
But I got to imagine for someone who does take care of their properties and does have that commitment to putting out a quality product, that it's got to be great to not have those because you're already doing the things that you need to be doing anyway.
Yeah, absolutely. Yeah, in the Twin Cities, for somebody that takes care of their properties, for a company like you guys, or for what I do, it's a nuance, right? It's just it's okay. We got to show up for the inspection. It just has to be done, but there's nothing wrong with your property,
right?
So in terms of these other markets that you can kind of get away with more, do you find by being a step above the competition that you're then able to even differentiate yourself more and get the top tenants, or is that not really translated into like higher wage earning, higher credit score type tenants? I'm just kind of curious as what's the positive effects of.
Yeah, I think it is. I mean, you're seeing positive effects by fixing it and actually doing a quality job, because a lot of the tenants have a hard time finding good quality housing in cities that don't have a lot of good quality housing. When you're taking a property, I just purchased, for instance, a 20-unit building, mostly vacant, but the units that weren't vacant were horrible. Your cockroaches, bed bugs, just gross cabinets that are falling apart, bathroom. It's just disgusting. It's horrible. And the outside of the property is in poor condition. Everything that nobody wants to live there. But these people have to have a place to live. And if you can't find a nice place to live, you're going to go to something that you don't necessarily desire. By fixing that up, you're getting a better tenant base, and B, you're getting higher rents as well. And so, I think in a city like Cincinnati, a city like Milwaukee, there's just a lot of inventory that's substandard. People shouldn't be living in, quite frankly. And so I think, and that's something I enjoy doing, is taking a problem and being part of the solution. Mm-hmm. And that's what I enjoyed about flipping, is we had a lot of distressed houses in the Twin Cities, especially between 2008 and 2014. And you took a problem and you made a solution out of it. You fixed it and brought that inventory back to where it should have been in the first place, but people just let it go.
Yeah. Whenever you flip a house, you make the neighbors happy too.
Yeah, absolutely. Well, most of the neighbors.
Right.
I have a question. Sorry, I was doing all the social media here. Maybe you already answered it. How are you able to effectively manage the properties living here and having buildings that are very distressed, in a different state, to make sure that the job gets done, and then once they're stabilized and the rents start coming in, who does all that for you? How are you able to make that work? Just from us being in the property management business and third-party property management, it's a big deal for us, and we manage in-state properties too.
Yeah, great question. I hire a company like you guys.
Okay.
And I think that's extremely important if you're not going to be hands-on with the property. If you've got even in-state, if you've got a job, or you just don't want to be spending all your time on a property, hire a company like you guys to do that. And that's what I do out of state is I hire a third-party property manager that takes care of everything. I also pay them a fee to help manage the construction.
Okay.
I ended up finding all the contractors myself. Okay. So they did not hire the contractors to do the renovations of the building, but they do deal with those contractors on a day-to-day basis.
Yeah, day-to-day basis, just to make sure the project is done.
Yep. Okay. Yeah. So I'm dealing with the contracts with the contractors. We're negotiating on the pricing. I'm giving them essentially my vision on the property and what I want done, and then the property manager makes sure that's being followed through.
Where are you sourcing those deals? How are you? So, do you have agents on the ground over there who are actively looking for you all the time, and are you then traveling to go see those properties?
Yeah. I'm a really hands-on person, so I travel to Cincinnati, or I do have properties actually in Milwaukee as well, but I travel every time I want to go find a property. So, or I shouldn't say every time I want to find a property. Every time a property has enough interest,
right,
to pay for the plane ticket,
right,
I go and look at them. I'll make offers here from in-state.
Right, with the due diligence period.
But by the time before I close on it, before the end of the due diligence, I've looked at the property. I've gone into all the units. I've got brokers in-state that I'm in Ohio that I'm working with.
Got it. And you have multiple different brokers that you work with?
Multiple brokers. So the commercial space is more of a old boys club or old girls club, old boys club, where you've got just these brokers that are sharing their listings with people they know are going to perform. Mm-hmm. And the only time they end up putting it, I shouldn't say the only time, but most of the time when they put it on like a LoopNet or the MLS, it means it's not a good deal.
Right.
They've already gone through their book of business and people that are buyers, and they said no. Yep. So now they're open to the general public.
Yep, absolutely. And being from out of state, it is difficult. I mean, when you ask me how did I go that route, it's difficult because they don't trust you right away, and that was really important for me to fly into the city and actually meet with them and make them understand I'm serious. And every single time I buy a property, I email the agents I'm working with and say, hey, I just bought a 20-unit property. I'm still looking for another deal. That way they know, oh, wait, he bought that property obviously with somebody else because it wasn't with me. I want to get this guy a deal.
Right.
So the more I think you contact them, make sure they know you're serious. And then that face-to-face is really important with anybody you're working with. And then I think that it's universal throughout the board, just meeting with people.
Within our business, we have clients that don't live here, obviously, but it's important for them to come here. I actually would like to see more of our clients who don't live in Minnesota come here and talk to us face-to-face. I know a lot of things are done over the phone or email or whatnot, but I think, especially if you're wanting to have a long-term relationship, it's important to have that face-to-face discussion to make sure your vision and goals are in line. So I'm a big kind of believer in you just got to meet people in person. You just got to get out there and make it happen. So
yeah, absolutely.
I agree from my perspective too, from doing it from the other side, because I work with a fair number of out-of-state investors, more targeting residential properties. But to the same end, and it really took the in-person meeting for either one of us to feel comfortable committing to each other to, if I find an off-market deal, it's tough to want to send it to someone you've only had a few phone calls with, to give them that opportunity to purchase it, as opposed to doing something else with it, some other client who is already in state, who you've done some transactions with. So when you did go meet them, what kind of conversations did you have? What did you do to be able to show them that you were serious?
Well, I think just meeting them, first of all, and actually being in the city really helped a lot, because these guys are approached by a lot of out-of-staters, and just through the internet, an email, maybe a phone call if they're lucky.
Right.
But that's it. So just meeting them really helped a lot. And then having enough knowledge to be able to tell them exactly what I'm looking for, exactly what I'm expecting, and my timeline. So going to the broker or whoever you're working with, knowing exactly your goals, to them, it's like, okay, now I can see their vision. Now I know what they're looking for, and they're serious. If you don't have a vision, if you just say, well, I just want to buy some apartment buildings. Well, what are you looking for? An apartment building. Well, how much?
Or
it doesn't
give me
matter.
a good deal.
Yeah, give me a good deal. I just want a good deal. Well,
what's a good deal?
What's a good deal? Let's nail it down a little bit. And if you don't know what a good deal is, well, then do some research. Latch on to somebody that knows what good deals look like, and figure out what your niche, what you want your vision to be.
And I can tell you from the agent perspective again too, it makes such a difference if you have a realistic expectation of what a good deal is.
Yes.
Because I can't tell you how many people call me and they're like, hey, I want you to find me a couple properties. I'm looking for about a 10 cap rate, 25% cash on cash return in a prestigious neighborhood. How many of those do you think we can get this year? I'm like, 0.
Yeah.
There's 0 of those, just so you know. And
I'm looking for a can't lose situation.
Right. Also, I don't know you. Like, that's number 2.
Yeah, I think we had a podcast that dealt with about the market here is as such where you can't just show up here and say, oh, I have $1 million, help me buy real estate, because a lot of those deals will be dealt with internally or with the customers that we already have an established relationship with.
Yeah.
So you have to be really creative. What I was going to ask you mentioned you did about 150 flips in your time and since 2008. So from a financial perspective, did you do a lot of those deals yourself? How were they financed? And then to build on that, how are you financing out-of-state deals? Are banks involved? If they are, how do you get a bank from here to finance something somewhere else? That I'm curious, because, again, it's something that we haven't done.
Yeah. So as far as the flips go, I started this business with almost 0 money. So it was other people's money.
OPM.
Right. And it was right away because my wife and I saved up maybe like 20 grand, and she let me buy my first property with all of essentially her money.
Yeah.
But that was a rental property, so we used all that money for the rental property, and then I had no more money left, so I had to figure out, okay, if I want to stay in this business, what do I got to do? So it was other people's money right away.
Okay.
I actually partnered up with a business partner who had a few other connections that I knew could maybe help with that process.
Private money or
private money?
Okay,
yeah. I didn't use institutional right away. I didn't use hard money. I actually didn't even know there was such thing as hard money when I first started.
Okay.
So I started using private money, and then I did find out that banks would actually lend to flippers. And most people didn't think so. In 2009, I actually got my first loan on a flip property. I called probably 100 to 150 Twin Cities local banks.
Wow.
And just told them exactly what I'm looking to do. I wanted loans on my rental properties, and I also wanted loans on my flips. And some banks said yes to both, and most banks said, you are crazy. Because this was 2009, mind you. So everybody thought real estate was the worst thing ever.
What bank gave you a shot?
The first bank was Blaine State Bank, who is no longer around. They're now owned by Core Trust Bank, and I don't know if they're doing that type of business. But the most aggressive banks that I worked with a lot was U.S. Federal Credit Union, who's now Firefly Credit Union.
Yep.
Same bank.
Yep.
The Sunrise Banks.
Mm-hmm. Okay.
They are a great lender for commercial. Great lender for commercial. Great lender for small, single families and multifamily rental stuff. Highland Banks.
Okay.
Who else did some? First American Bank was very aggressive, and I think they still are. They have some great programs available. So that's First American out of Hudson.
When you were getting these loans, you mentioned you using other people's money, but then when you finally got into getting loans from banks, at this point, did you have like 2 years tax returns? Did you have an actual W-2 job? As far as getting approval, how difficult was that?
Yeah, when I first started getting the loans, I did have a W-2. I used to be a high school teacher. So I wasn't making a ton of money, but my wife was also making decent money. She was the breadwinner. So between the two of our incomes, we were making enough to be able to help
to get pre-approved with 25% down.
Yeah. And I don't know. After I went and quit my job, I had enough experience by then because I was doing 10, 20 flips a year plus. So I had built up enough experience pretty quickly. A lot of my deals, though, especially the flips, were done with private money. So, and even when I started getting bank financing, I kept on wanting that private money to help finance me because I just the power of being able to have that private money to be able to step up the game or to use that private money future down the road. You want people to trust you.
When you got private money or other people's money, was every deal different, or did you put some kind of a strategy in place where, hey, this is how I'm going to do business? As far as flipping goes, did you basically just get money and had a set return rate, or did you go into a full partnership where there are splits?
Yeah, so it kind of evolved throughout the years. When I first started, the investor was getting 60% of the equity, and I was getting 40%.
Right. But you were doing all the
I was
work.
doing everything.
Got it.
After a while, then it switched. I was getting 60%. They were getting 40% because I had that track record.
Yep.
And I felt I could do that. I also kind of it was flexible a little bit. So I had some investors that just wanted the straight interest rate. So then I would say, okay, you got no equity, and they would get 12%. And now I use a lot of private money for the multifamily, and that's all structured, and it's a system that I have. I mean, it's just depending on the deal, my equity partner gets a certain percentage of the equity. They get a preferred return on their money, and they get the payout at the end.
All right. So right now, the bigger deals that you're doing out of state, they're mostly whoever's coming in, they want some equity, not just a straight return.
Yeah.
But you're the managing partner. You're making all the decisions.
Yep.
You're doing all the work.
Yeah. So it's an LLC. I'm the general partner, and my private investors are the limited partners. We also get a loan on it. When you ask the loans for the out of state, it's mostly local Cincinnati banks.
Really?
Yeah.
Okay.
So the local banks around here don't want to lend to you way out there. The only bank I shouldn't say the only, but the banks that are more willing to are the bigger national banks. Like a U.S. Bank I do business with. And they'll lend on real estate.
In Cincinnati?
In Cincinnati.
Yeah, okay.
And in Milwaukee. Because they've got branches in both locations, so it works out.
Do they just require, again, tax returns and your track record, or do you have to make a presentation on top of your return, say, hey, this is what I've done, since 2008. I can, I'm guessing it's, let's say it's $1 million plus asset that you're buying, and they're kind of like, okay, should we lend on this guy who lives out of state?
Yep. So what they require and what you should do are two different things.
Okay.
What they require is going to be fairly basic, but I think you need to do a presentation to them that tells them about who you are and why this deal is going to work. So all your experience, I write a whole business plan, a 5 to 7 page business plan on the property specific. Exactly what are we doing on that property and why is it going to work? What's the market fundamentals? Everything. They might know half the stuff that I put in there, but I want them to know that I know. And so they can see me as, okay, this guy's he's got it. He understands.
That'd be great if you're willing to share that PDF with us. You can actually email to me or whoever, and then we can link it to this podcast so people can get a hold of you, obviously for business purposes, but also can see kind of if they want to go into that world. If there are a lot of opportunities, not just in Minnesota, and I think our hesitation, both Ryan and myself, to go anywhere else is obviously lack of knowledge, but also the control factor that we give up. Then we have to kind of start from scratch, because here we know everything that's going to happen, from the construction to the management to the acquisition and the disposition of that particular asset. So it's interesting that you kind of just went at it
Well, it wasn't just kind of went at it.
Well,
it took me a long time to
right.
finally get myself to finally jump and say, all right, let's do it. Because, like I said, I researched for a year and a half before I even took a plane and flew to. So I'm sitting in front of my computer going, I know this city's great. I need to invest here, but man, I'm just scared to do it. Because, like you said, you're not there. You can't. Something goes wrong with your property, you can't just hop in your car and drive there. You got to book a plane ticket and get out there, and it's expensive. And it's like,
and it's important to have that, the management company or whoever you have there, that they're in line with what your needs are, and then they can take care of it, so you don't have to worry about if things go wrong. And I'm assuming things have gone wrong.
Yeah. Oh yeah. Yeah. It's you're in business. I mean, but kind of what I don't know. It was just. I was just sitting here going, you know what? Does Ray Kroc, the founder of McDonald's, did he go to every single McDonald's that he owned or that they franchised and go to them every day and check in them? No. Why do I have to go to my properties every single day or be available every day to go look at them when the most successful businesses, they don't do that? They've got locations all over the country and all over the world.
Right. It's trusting yourself to trust the right people a lot of times.
Yeah. Are you confident? Like, for example, it sounds like, especially you mentioning the founder of McDonald's, do you have a system in place that you can say, hey, this is a good system that I can go into any market to analyze it, and if it's a good market, then you proceed to step 2, 3, and 4 and actually, buy a deal and have it produce income for you?
Yeah, I do. Part of the problem though is you also have to go into a market. Just because a market looks good on paper doesn't mean it's good. So I think you need to either have people you really trust to have feet on the ground, or you need to have your feet on the ground. I went into Memphis thinking, man, Memphis looks like a great market. On paper it does, but no offense to anybody that lives in Memphis, it's a scary place to go. I mean, there's a lot of crime, and it's just a different city, and it's a city that after I left, I just decided it's not for me.
Yeah,
that's a good point. That obviously everything can look right on paper, like with so many other things, but then it just doesn't work in the real world. When you finally put everything together on paper and you decide to go to Cincinnati, you flew there. What was your first day or week like? Did you take 2 weeks, and were you just there at a hotel and every day?
Can I actually back it up a sec before we get into that? So we got the genesis of you acquiring these properties and at like the ideal time to start doing this, and got to the point where you were doing 20 to 25 houses a year, flipping them. Is that about?
Well, yeah. I mean, that's generally about right. I would say it increased up to a point where I think, I can't remember the year. My head spun so much that year. It was like 2012 maybe.
Yeah.
We ended up doing, I shouldn't say I, because it was with a business partner. Mm-hmm. We ended up doing close to 50.
Yeah. That's
and
substantial.
Between the flips, and we were also buying rentals. So I think we bought that year well over 50 properties.
Gotcha.
Yeah.
So the reason I brought it up is we had Rafiq Moore in last week, and kind of a similar story. And what I asked him was, it seems to me that there's a point where you're doing the residential side, and a lot of people ease their way in by doing that. And then there's this moment where your time is it's just saturated, right? Like you have no free time. Scaling up the current business doesn't really make sense. It's not, you can't add more time, more deals to yourself. So you either need to get to a point where you start delegating, bringing in other partners, or you need to change your entire paradigm and move into the commercial world. And it seems like that may be kind of where you're at. Can you explain what it was that made you go from living in this world of residential to getting into the commercial world of large multifamilies?
Yeah, it's easy. I split up with my business partner.
Gotcha.
My business partner liked doing the flips. And not that I didn't like it. I'm glad I did them because it was a good learning experience. But I wanted, and my goal when I started real estate was to acquire 1,000 units, 1,000 rental units. I just wasn't getting there. And I'm going, well, if I'm going to get there, I got to actually do something. I can't just buy a single family here and there, because it's going to take me. I got to live to lifetime. I got to live to be 300 if I'm going to do that. So I went.
Do you watch Grant Cardone, by the way? Grant Cardone?
A little bit, yeah.
You share the same mindset.
Yeah. So it was just one day, just going. Once we split up, going, where do I actually want to be? And my goals have changed slightly from the 1,000 units. I don't consider units as a goal anymore. I consider the amount of real estate that my company, along with my investors, are going to control.
What's that goal? Just out of curiosity.
$200 million.
Gotcha.
So for that, and that's not a lot, Well, it is and it isn't.
Just a casual $200 million.
Right.
It's walking around money.
Yeah. That's the real estate that I want to control. That's not just the cash flow.
I gotcha.
So that's after you and your partner parted ways.
Yeah.
He or she decided to do they were comfortable with the flipping of single family homes
it wasn't quite as, it just to not get into the whole split up. It just wasn't working anymore. And I wanted to go my own way. And I think he needed to go his own way. And so without getting into it, that's just, that was a simple solution, is to just say, hey, let's part ways. You do your thing, I'll do my thing.
Amicably, hopefully?
Yeah, it was pretty amicably. I mean, it's a partnership deal, and you both have different ideas of what the value is, but I think we worked it out fairly amicably.
Gotcha. Does that answer your question, Daniel?
Yeah, it does. I was more going for the why, but I think you're
right,
asking about implementation. Yeah.
Right. Yeah. Well, to kind of summarize, basically you had other vision and goals. First it was 1,000 units. Now it's this, $200 million in controllable assets. And my question was, when you were looking to go towards your goal, and the way you were going to achieve that is by, getting buildings, not single family homes, just because you're not going to live to 150 years old. And you did extensive research, and it was time to go.
Yep.
And did you book a one-way flight, or were you going to just stay there for a couple of weeks? What was your strategy? Were you just going to walk the streets and go from neighborhood to neighborhood? Did you get real estate agent?
Mm-hmm. So I had done a ton of research, like I said before, and I have been in contact with brokers in Cincinnati and in Jacksonville and in Memphis. And so I had relationships with all those people. So what I did is I booked one-way tickets to each city, and I did 2-day stints at each city. I've got kids and a wife, so I didn't want to be gone forever. So so I flew to those cities and decided on which city I liked the most and wanted to focus on, because I didn't want to just be buying all over the nation without any focus. I wanted to just pick one city, focus. Once I feel like, okay, I get this investing out of state, then picking another city is okay. But I think you got to go a little, right? You got to go a little slow. You can't just buy in 20 different states and think it's going to be all okay. But so to kind of answer your question, I'll just use Cincinnati as an example. My first time that I was there, I had meetings set up. I was crammed. I had meetings set up from 8 a.m. to as late as people would meet with me, 7 p.m. And then from 7 p.m. until it got pitch black outside, I'm driving neighborhoods and looking around. I was up. I mean, I think I slept probably 2 hours. When just.
But it was necessary.
It was all about figuring out what's going on with that city. I met with real estate brokers. I met with some lenders. I met with property managers. I looked at a lot of properties.
Contractors, I'm sure.
Contractors. And just trying to figure out what the neighborhoods are like and where I would want to be and where I wouldn't want to be. And Cincinnati, if you've ever been there, is a crazy city as far as trying to figure out where anything goes. It's not on a grid. It just it just
there.
goes. Yeah, the roads are just everywhere. They run into each other. They Y and they.
Like an old European city, kind of.
Yeah, it's crazy. It's on 7 big bluffs. And so then there's the valleys and the bluffs, and so everything just kind of winds all over the place. So you can't. I've been there a lot.
I've never been there.
I still can't figure it out.
Gotcha. So are you at a point now where the commercial, the large multifamily, has surpassed the valuation of your portfolio that you spent, much more time accumulating, or
Not quite.
not quite? Okay.
No. So I have my rental properties in the Twin Cities, around that 50 unit range, and the rental properties outstate are in the 100 range, but the outstate are valued a little cheaper. I would say it's probably about 50. It's about equal right now.
Okay. When you're looking at it, and we were talking a little bit about the economy in general before we started the podcast, and I think that's on a lot of investors' minds right now is, new president, economy's doing really, really well. A lot of talk of interest rates increasing, a lot of people wondering whether or not the increase in home values and real estate values in general is sustainable. And, we were just kind of touching on a few points of that. What made you recently decide to get into commercial, where, you're already in a position where you're getting these commercial loans with adjustable rate mortgages after some 5-year, 10-year fixed term, decide to purchase properties and expose yourself to some of that risk when, companies like Blackstone, et cetera, have come in and purchased so many of these large multifamilies, compressed the market, and they're not leveraged. So they don't really have that same exposure. How did you kind of analyze that risk reward and come up with the conclusion that you did?
Boy, that's a big question.
Sorry, I know. We'll all talk about it because I think it's really interesting.
It's definitely difficult to do because, like you said, there's that risk of where are we heading. But isn't there always that risk?
Always.
And that's why I invested out of state, not in state, is because in state, we've got this huge cap rate compression, I feel. Out of state, in the markets that I chose, they have cap rate compression, but it's not as severe as us. And so there's still that opportunity. And by buying a distressed property and doing a value add on it, now you're forcing equity into your property.
Right.
So you're going to get in trouble if you say, okay, I just bought this great property, I value added it, now let's pull all that money out.
Right.
Now you might get in trouble doing that unless the market continues for a long time. But if things change, then you're going to be stuck. So what I tell my investors when we buy this property and we have a great value add, I'm not going to pull all your money. We're not going to give you all your money back. We may pull some money out of it. We might not have a full 25% down payment. Mm-hmm. But we're not going to have a 0% down payment when it's all said and done. It's just not going to happen because I want enough equity sitting in that property. Yeah. My goal is for every property to have 30% equity sitting there. So then that gives you some cushion. The market now can go down by 30%. You're still not underwater.
Yeah. Well, I think a lot of people just don't consider it and don't have any sort of plan.
Yeah.
And those are the people who, unfortunately for them and the economy a little bit here, are the ones left holding the bag and kind of provide a lot of the opportunity that you were the beneficiary of in 2008.
Absolutely. Yeah. When you leverage your property to the max, good for you because now you got cash to work with. But what good is that cash when it's all gone, when everything does go down, or when interest rates go up and no bank will touch you because you're so highly leveraged that it just doesn't make sense. So
I think it comes down to having some disciplined fundamentals that you stick with. So about a year and a half ago, when we saw the real estate market starting to really gain traction, I remember that Goran and Dario and I sat down and we attempted to establish some criteria and said, okay, let's not get overzealous. This is what we're going to look at, and anything that doesn't fit in this box, we're going to pass on. Because when I bought my first investment property in 2009, we got a 13 cap. gap, and it took me 10 days of analysis to make the decision to go for that. And now, obviously, I would jump on that in a heartbeat. But what we came up with as criteria was we wanted to see a minimum of a 3% difference in the cap rate and the interest rate in which we can borrow at, giving ourselves a little bit of cushion there. We also look for a maximum of 80% cost of value. So when we look at the purchase price plus the rehab, closing costs, bank fees, all that other stuff, we don't want it to exceed 80% of its market value after everything is done, because between that and the bank's down payment, we'd be in a similar equity position to what you're saying, which we're probably at a blended average right now of 60 to 65% on our properties. So if the market were to go down 15, 20%, I actually still have enough equity in there, that 20% roughly that they would require to be able to, fix my loan again for another 5 years.
Absolutely.
But, there's no way to fully eliminate risk if you want to continue to grow. But I learned from my very first job in real estate, which was on the hotel side, the benefits of being a disciplined investor and the benefits of seeking value at all costs. Just because you know something well, just because you're good at something, doesn't mean that that's what you should do forever. You have to be somewhat amenable to the opportunities that are out there. I commend you for your bravery in terms of expanding from the market, which to geographically, that is, not just from single family to commercial. I think that we've had some internal discussions about doing the same here, but we've been hesitant because we're so vertically integrated around that real estate investment here with the construction, the management, the brokerage, all that kind of stuff, that we're more leaning towards just venturing into the commercial side rather than going into different geographic markets. But
I think we're still in the process of ironing out the right process where we can then put it into a different market and then replicate it as efficiently as we can here, which is another, like I said, the reason why we haven't ventured in there. But
and you guys are thinking about it the right way, though. You're being thoughtful in what is actually happening in the market instead of just going forward and buying everything out there just because that's what you think you should do or were told you should do or always did. You're being thoughtful and you're trying to keep your if you have an actual system and guideline in place and you follow it, you should be fine as long as it's a good guideline to begin with. But where people get in trouble is when they deviate from that and they go, "Wow, geez, man, I haven't bought a deal in 6 months. I want to buy the next real estate deal. I'll just buy this one." What does it? It doesn't fit your guideline. Why would you buy it?
I see that a lot when folks are in a 1031 situation.
Yeah. Oh, yeah.
And they sold this property. They made a nice gain. They probably made all the right decisions on that purchase and that sale. But then they're faced with a tax consequence, and they're willing to buy a property for, let's say, 20% over value to save the 20% in taxes, and it just is kind of it's a head scratcher for me when I see that kind of stuff.
And why save that money on the taxes when you bought that property 20% over value? That's a risk too. It's not like your property is bulletproof and you're going to get your rent 100% of the time. I mean, you still got risk.
Right.
So you guys do property management. You know that every tenant is not the same.
No.
So
we wish that was
you wish, right? But it's just not.
So I had a question for the listeners that are out there that want to get into real estate, and obviously they're short on funds, and they want to go via private money or friends and family.
Yeah.
And it seems like that's how you started.
Yeah.
What type of tips or suggestions you would have? Who would they reach out to? Because you can't just go online and say, "Hey, I'm really good at real estate. I'll give you a 10% return.
Yeah.
Give me your money."
Right. So I think you either have to have people in your personal network that that would be interested in it, or you have to find somebody. Like in my instance, I partnered. That was my first partner. He didn't necessarily have the money. I actually thought he did, but didn't really have enough to.
He just had access to other
But
people.
he had access to other people. And so if you can have access to other people that have money, whether it's through a partnership that you form or whether it's your own in-network, that's how you get started. And I think just getting your name out there and networking, that's one thing I didn't really do a very good job of. I did a lot of flips. I was probably one of the top
Well, it
flippers.
seems like you did a really good job at as far as the numbers go.
Yeah, you know what? I shouldn't say I did a bad job at it, but I think I could be ahead of where I'm at right now is because I didn't talk about what I did from 2008 to 2015. I didn't tell anybody that I was flipping properties. And not many people knew my name just because I didn't want to tell people about it. I didn't think it was important. I was just flipping properties. What do you mean? So I think if you go, well, I want to build my business, but I don't have that money to do it. Well, get your first deal. Use hard money if you have to use hard money. Be successful at your first deal. Tell everybody that you meet what you're doing, and then just continue to do it day after day. I mean, the more deals you buy, the more experience you have. And when you talk to people about getting money, it's not, hey, Ryan, I've got this apartment building I'm buying. I need money for it. No, you're presenting Ryan with an opportunity. Hey, Ryan, would you like to make 20% return on your investment? I've got a deal that I could maybe fit you in on if it works for you. That's a different way to approach it versus just give me money, Right. So I think it's how you approach it, how you network yourself, how you put yourself out there. And I'm not this overly confident, special person that money finds me. It's just that's not. I wish it was, but that's not how it is.
Me too.
Right? And don't we all do? Right?
Yeah.
We all just wish money just came to us because everybody looked at us and knew we were amazing people, but it's just not how it happens.
Yeah, you have to make an effort. I think it's true. Just like you made an effort to get into another real estate market, you have to make an effort to raise funds or raise business partners, and that won't happen on its own. You have to put yourself out there, and I think that's one of the reasons why you are here. This would be probably your first podcast regarding what you were doing.
Yeah, so I'll be on a podcast with a gentleman named Joe Fairless, who has a podcast called The Best Real Estate Investing Advice Ever. It's a daily podcast, pretty good one.
Where can we find it, or our listeners?
Yeah, if you just do a Google search for Joe Fairless, so Fair less, that'll come up. Otherwise, it's called The Best Real Estate Investing Advice Ever.
Is he local or
he's actually from Cincinnati, and and that's not even just coincidence. Really.
Wow. Okay.
Yeah, so
that's interesting.
But yeah, to go back to your question, I mean, I think it's important to get your name out there and really let people know what you're doing. And so I've been trying to just do a lot more networking. I actually reached out to Ryan the other day I'm just trying to meet people that are in our local market doing business, and the more you can understand what other people are doing, hopefully you build a relationship that's beneficial for both sides, and being able to do. It's all about trying to build your business and help other people build their business. So.
I think that's one of the main reasons why we have the VSM podcast. I mentioned that we have a lot of different guests here, and you and I just met today. You met Daniel today just before the podcast, and this is a platform for everybody to kind of speak their mind. It's kind of the Wikipedia of real estate podcasting, where somebody that's listening may get something from your podcast that would then spring him into their next real estate deal or give him enough courage to actually move forward with it. That's the platform that we're trying to create. So I'm glad you reached out to Ryan and that we connected. And what a great way, instead of everybody's like, hey, let's grab lunch or coffee, but how awesome would it be if 1,000 people could hear that conversation?
Right.
And this is our way of putting that together. We don't have the coffee, but I see you got our water, so I think we're covered.
It's just as good.
Yeah, no doubt. Well, thank you so much for being here.
Absolutely.
Tons of insight. Really, really interesting, I think, specifically to follow again, speaking with Rafiq, who has somewhat of a similar pedigree, but you both kind of took it in different directions. You took it to a different market. He focused on a different component of real estate.
Yep.
So it's just showing how once you really understand what you're doing in this business, how many other branches kind of come out of that and how many other opportunities develop for you. So thank you so much for being here.
Yes, thank you very
Yeah, I
much.
appreciate you guys having me on.
And thanks for listening, everyone.
Hey, thanks for listening to my interview with VSM, and I appreciate those guys at VSM giving me the opportunity to come in and share what I've done and my experience and thoughts about just market and managing and all that kind of stuff. So great, fantastic group there at VSM. Ryan and Goran and Dario are fantastic owners, and if you're looking for some good property managers in the Twin Cities, they're definitely a group to get a hold of, or just learning basically from them. Fantastic podcast as well. So my name is Todd Dexheimer. I am signing off from Pillars of Wealth Creation. Don't forget, please like us on Facebook, subscribe to our podcast, and give us 5-star ratings. We'd love to hear from you. That's how we're going to grow our channel. That's how we're going to grow our audience. So if you could do that for us, that'd be great. Remember, every day is Saturday. Want to learn more about real estate investing? Tune in to the best real estate investing advice ever with Joe Fairless. Joe has the longest daily running podcast on iTunes, well over 1,000 episodes. You can listen to me on Joe's podcast, episode 1015, where Joe interviews me and asks me about my best real estate investing advice. Joe has interviewed fantastic guests such as Emmett Smith, Robert Kiyosaki, Barbara Corcoran, all kinds of fantastic guests. Make sure that you go on to Joe's podcast, subscribe, give him a 5-star rating and review. You do not want to miss out on a fantastic podcast, the best real estate investing advice ever with Joe Fairless.